So recently, I encountered a common mistake that people investing in long-term stocks make. The problem is that they judge their portfolio performance in a few months for a long-term strategy. Now, for example, you invest in Apple, but it didn't go up for a month or two. You think you made a mistake, right? But the question is, did you really make a mistake? This is a key distinction between long-term and short-term investors. Now, before we start, I just want to celebrate another two case success stories in Investing Accelerator where Mike made 114% from ADP in 6 months. Chris made 37% from TSN in 3 weeks. Back to the video. For short term, you take action today and you know the results tomorrow. For example, you buy a stock right now and you take profit after making 1% return. Woohoo! That's fantastic. Now for long term, you take action today and well, nothing really happens. Well, you're not going to take profit tomorrow, right? I mean, if you take a profit tomorrow, then that's not really long-term investing anymore. And when I'm discussing investing with my parents, they make the same kind of mistakes too. They love the thrill of taking profits early, and they get sad when the stock market didn't go their way immediately. Their expectation is that the stock will go up immediately after they purchase, which of course sounds really silly in this video right now, but it is true. It happened to my parents, and I'm sure that secretly we all hope the stock goes immediately in our favor after we bought. But in reality, we know that doesn't really happen. Sometimes you take action today and you are in the red, and that's probably the most difficult part of investing. If you want to become a better investor and have better control of your emotions, then click like on this video to let YouTube know that you like these kind of videos. But the question is, are you wrong? Now, in the stock market, it is easy to think that seeing red as being wrong. When you see red, you immediately think that, you're losing money. It's time to panic. This long-term strategy doesn't work. Why did I invest in the market, but it didn't move the next day? These are all symptoms that perhaps you're thinking you're the center of the universe. And those are probably some of the statements that go through your mind if you're evaluating a long-term strategy using a short-term mindset. And when you are investing in the market, like me and you, where we are retail investors, we really have no power to control the stock price at all. You are just participating in the stock price, but you don't really change it, you don't really move it, so you don't control it. Now, it gets worse if you are using options as well. And that's why I don't really teach options on this channel, because it is quite difficult and dangerous. It requires careful planning and thorough thought process to think through all the possibilities. A high degree of emotional tolerance as well. Options can make you feel like the biggest loser in the world. Unless you can make options investing very safe, it is very dangerous to just learn bits and pieces of options without proper education and expectation, like you're learning options on YouTube. Now, what is the solution? If you are ever fortunate enough to be friends with some of the world's best mutual fund managers in the world, then you will realize that long-term mutual fund managers are very calm. They don't react like a madman because their position is in red. In fact, they don't expect prices to go up immediately when they buy. When I work with, interview, and converse with some of the best hedge fund managers in the world, they are very calm. They're logical. They do their research and make the right decision. Then they stick with it. How come they have the conviction to do that? And this is because they keep the big picture in their mind. They know why they're investing. Just because the market goes up one day or goes down another doesn't really change the reason why they invest. The reason of why you invest is extremely important too. Now, of course, everyone wants to make money when it comes to investing, but it is not the reason to invest in a specific stock. The reason you want to invest is the result of your research. it is your investment thesis. You need to analyze the technical environment, the fundamentals of the company's performance, the company's strategy and products. Sounds like a bit of work, but remember my Apple example in the very beginning? I think we all know that Apple has been going up for the last 10, 20, or even 30 years. But what if you invested during the week of August 31st, 2020? In 3 weeks, Apple dropped from $140 to $100. That is a 29% drop. Now, if you invested in a great company, this is a perfect example where you invested in the highest high or you are too early as well. And the market is just not going up yet. Even if you invested in Apple, you still experience a 29% drop in 3 weeks. And it is Apple. We're not talking about some new IPO stocks or penny stocks. Imagine the roller coaster you need to go through if you're investing in the higher risk IPO or penny stocks. If you purchased Apple at $140, which is the highest high during that time, in August 2020, and you held on for 1 year, Apple is currently $150 as I'm recording this video, which still represents a 7% gain for you in 12 months. And even if you are absolutely horrible at timing the market, you're still coming out on top with Apple. That's why it is important to know what you're investing in, do your research, and be committed when you're right. And if you're wrong, of course, you need to get out immediately. So I like to end the video with one quote from Michael Burry in the movie Big Short. And it is,
"Watch, it will pay. I may have been early, but I'm not wrong."
I'll see you in the next video.